This is the story of how everything changed. I want to share exactly what it took to raise our round, start to finish. It wasn't easy. It took 40 pitches in total, 37 ended in a clear no. But we kept going, secured 3 term sheets, and finally closed the round. But before you even think about pitching, you have to ask yourself, should you raise at all? Neither path is universally right. If you bootstrap, you keep 100% control and all your equity, but you might face slower growth. If you take venture capital, you get massive resources and speed to scale, but you'll have to deal with dilution and board oversight. If you do decide to raise, understand the landscape. Pre-seed usually means 10 to 500,000 from angels and friends. Seed is where you likely are, 50,000 to 2 million to fuel early product traction. Series A is 2 to 15 million for a proven scaling model, and Series B and beyond is for massive growth acceleration. So, who actually invests at these early stages? Angels and accelerators are your best starting point. Angels invest their personal money. Accelerators like YC provide capital and structure. Then you have micro VCs who specialize in early stages. Institutional VCs, they rarely do pure pre-seed. When should you go to market? You must raise from strength, never desperation. Your sweet spot is where solid traction meets enough runway. Investors want to see sign-ups, letters of intent, paying pilots, active users, and most importantly, early revenue. When figuring out how much to ask for, don't over-ask or under-ask. Take your monthly burn rate, multiply it by 18 months, and add a buffer. The goal is to show how this capital gives you 18 to 24 months of runway to hit your next primary milestone. Let's talk about the cap table. One common mistake is not setting the option pool before the raise. You want your post-raise cap table to look roughly like this: 65% for founders, 20% for investors, and 15% cleanly carved out for an option pool. Your pitch deck is a story, not a brochure. Focus on 10 core slides. Start with the problem and your solution. Prove the market and your business model. Highlight your traction and why your team is the one to execute this. Finally, map out your roadmap and your grand vision. Walking into any meeting, there are 5 numbers you must know cold: your monthly burn rate, your exact runway, your MRR or ARR, your customer acquisition cost, and the lifetime value of a typical customer. To find the right investors, target them by stage, sector, and check size. First, build a list of over 100 names. Second, research mutual connections. Third, ask for double opt-in intros. And finally, run the gauntlet of meetings and follow-ups to secure a term sheet. Cold outreach rarely works. Spend time mapping your network on LinkedIn. Remember, the absolute best introduction you can get is from a founder that the investor has already backed who is currently doing well. Investors trust other successful founders. When you get that intro, keep your first email under 150 words. Establish credibility quickly. Explain the problem you solve. Highlight your early traction and make a specific ask, usually just a 15-minute introductory call. Treat the pitch meeting as a conversation. If you have 20 minutes, spend 2 on context, 5 on the problem and solution, 6 on traction, 2 on the team, and leave 5 minutes for a dynamic Q&A. You will face hard questions. These are tests of conviction, not attacks. What if Google builds this? Highlight your niche focus. Why you? Point to your founder market fit. Why now? Detail a recent shift in the market that makes your timing perfect. Always follow up within 24 hours. Be crisp. Thank them for the time, summarize key points, Provide strong answers to any open questions, attach your forwardable deck, and gracefully suggest the next step. Run your fundraising exactly like B2B enterprise sales. Use a CRM. Run parallel meetings to create FOMO and create artificial urgency by setting a close date. Remember, momentum is your only true leverage. Understand the real math of rejection. A no usually means not yet or a wrong fit. It rarely means you have a bad idea. Expect 90% normal rejections and aim for a 10% target conversion rate. It's a numbers game. If you hit 20 pitches and they all pass, start reading the signals. Is the market too small? Pivot. Are there team gaps? Find an advisor. Lack of traction? Stop raising and go get more customers. When you finally get an offer, know what you're signing. Understand pre versus post-money valuation, pro rata rights, board seats, and the difference between safes and priced rounds. Know what's worth negotiating. Fight for your valuation, pro rata rights, and board control. Let go of standard information rights and minor legal semantics. Protect what matters. Closing the round takes 4 to 8 weeks after signing the term sheet. You'll go through due diligence, sign long-form documents, and update the cap table before the wire hits your bank account. Always hire a great startup lawyer. Once the money is in the bank, the real work begins. You now have fiduciary obligations to deploy capital efficiently and hit your milestones. Raising money is not the goal. Building a great company is. Looking back, a few things stand out. Build relationships before you need money. Your story is just context for your metrics. Rejection is data, and the round isn't done until it's legally closed. The easiest way to raise is to walk into a meeting with a live product, not just a deck. If you want to build your MVP in weeks instead of months, check out needmvp.com to launch faster. If this guide helped you, hit the subscribe button and click the bell. Every week, we're bringing you new, verified founder stories and tactics to help you build and scale. Keep building.